The economic cycle describes how the economy shifts from a phase of growth to recession and then 005 circles back to growth again. It remains one of the most powerful forces affecting the stock market. 009 This cycle matters greatly since it plays a key role in shaping corporate earnings. 013 Which are arguably the most critical element driving stock price movement. 018 Things begin to get complex when we consider how the cycle affects various sectors differently. 023 Different stock market sectors react to different phases of the economic cycle. 027 In simple terms, while some sectors perform well during economic expansion, others tend to do better. 032 When recession hits, this shifting performance is what investors often call sector rotation. 037 Sector rotation happens as investors adjust their stock holdings based on where we are. 042 In the economic cycle, buying and selling accordingly during phases of recession and recovery. 47 Let's now walk through a typical example of how sectors usually behave throughout the cycle. 052 Suppose the economy is just starting to come out of a recession. One of the first sectors. 057 Investors tend to move, or rotate, into is financials, which includes things like banks. 103 Brokers, and insurance firms. Why? Well, by the end of a recession. 108 Interest rates are often at levels that favor businesses such as banks. So, 113 Anticipating recovery, investors usually rotate toward the financial sector. 118 Once the cycle starts trending upward, the next sector investors commonly shift into is technology. 124 This sector is very sensitive at the beginning of the cycle since companies often invest 128 in new technologies to improve efficiency. As recovery strengthens, 134 Investors generally rotate toward the consumer discretionary sector. 138 This includes industries like automobiles, housing, and retail. 142 Essentially, non-essential goods. As confidence among consumers improves. 147 With the recovery, spending on these discretionary items tends to increase. 152 After that, investors typically shift into industrials and basic materials. 156 This happens around the mid-phase of the growth cycle. 201 When these companies ramp up production in response to growing demand. 204 As the growth cycle progresses, investors often rotate into the energy sector. 209 At this point, energy companies benefit from the rise in demand for transporting 214 goods, which began in the prior stage when growth gives way to recession. 219 Investors usually turn defensive and shift toward sectors less impacted. 224 By the economic cycle. These are called defensive sectors because the 246 defensive sectors typically offer. At the start of a recession, investors often rotate 251 into consumer staples companies that provide household goods, food, and drinks. 303 People still need to eat, drink, and maintain their homes even in tough times. 307 Which is why staples become a popular rotation target during early recession. 311 As the downturn continues, investors usually rotate toward utilities since people 317 still need gas, electricity, and water. When the recession deepens further. 323 The healthcare sector becomes a go-to, because healthcare is something 327 people always prioritize, no matter the economy. By the end of the downturn, 332 Investors often rotate into the services sector, which includes things like waste management and staffing. 336 After this stage, the economic cycle typically restarts, and investors may rotate. 340 Back into financials as they anticipate a new wave of growth. 03. 45 So, how can you recognize when sectors are rotating in and out of favor in the ideal way? 351 Described above. A good starting point is to track price trends across different sectors. 401 For instance, if the recovery is already underway, you might notice new uptrends. 407 Developing in industrials or basic materials. On the other hand, if you're in a deep recession. 412 Watch for rising trends in utilities or healthcare sectors. 417 Understanding sector rotation can help active investors make smarter portfolio adjustments. 421 Even though there may be clues that a sector is moving in or out of favor. 427 Predictions are never certain, so it's smart to wait for confirmation signs. 432 For example, when an investor suspects a sector may be gaining favor. 437 She might hold on to her current investments in that space or explore fresh opportunities. 441 Conversely, if a sector seems to be falling out of favor, she might raise stop losses. 04. 47 Or consider selling positions to lock in profits or prevent further loss. 451 Using sector rotation this way can offer strategic benefits for investors. 458 But it also requires experience and time. You should ideally go through 5031 Full economic cycle to watch how sector shifts happen. 508 Before relying solely on this strategy to guide your decisions.